In today's video, we're going to be going through the different stops available to you as a trader, and hopefully find out which one's best for you. Now, breaking it down, there are 4 different types of stops. These are going to be stop markets, stop limits, trailing stops, and trailing stop limits. All these orders are generally designed to close you out if the stock goes against you and stop you from taking on any significant losses. All of them can be used to open up new positions as well, but that's not what we're going to be talking about in today's video. Now, to start off with, let's go ahead and jump into stop market orders. A stop market order, often called a stop or stop loss, is meant to protect a trader against a significant loss if the underlying stock moves too far in the wrong direction. This means we're going to be setting a trigger price at which a market order would be sent out to either buy or sell the stock that we're holding. The market order is not going to be sent out until the stock hits our activation price. Basically, it's a way to get out of the stock immediately if it starts to go against you and hopefully avoid losing too much money. Now, how does a stop market order actually work? Like I said before, you can use a stop market order to enter into a new position. However, you're typically going to be using them to limit your losses on a long or short position you already hold. For example, let's say you bought some shares of XYZ stock at $100 a share. You want to limit your losses in the event there's a sell-off, so you decide to place a stop at $95 a share. Now, in the event the stock were to actually drop down to $95 a share, your stop activation price, your stop is going to be triggered, and a market order is going to be immediately sent out. Since it is a market order, you will be filled immediately, but the fill price is an unknown. The fill price is going to depend on whatever the bid ask is at the time the order is sent. Let's say that the best buy order or bid available at the time the order is sent is $94.80 a share. You're going to end up selling your shares to this buyer despite it being 20 cents lower than your stop activation price. The difference between your stop and the price you end up filling at, that 20-cent difference, is going to be known as slippage. Now, this slippage could end up leading to more significant losses than you expected, but the stop market order will still get you out of your position and protect you against any further losses on the stock. Slippage is also not much of a concern during regular market hours and under normal stock conditions. The times to really be concerned with this would be if there's a significant gap up or gap down in the after hours. Keeping in mind that stops are only active during regular market hours, despite the stock continuing to trade in the pre and post market. Using the same example as before, you have a stop on your shares of XYZ stock at $95 a share. The company closes the night before at $102 a share, but is going to be announcing their earnings in the pre-market prior to market open tomorrow morning. In this example, the earnings are well below what everyone expected they would be, and the stock sells off to $88 a share in the pre-market. When the market eventually opens up at 9:30 a.m. Eastern Standard Time, your stop is going to immediately trigger and send a market order out there to be filled. Your market order is going to end up filling at $88 a share, the best bid or buy order at the time. Now, this is well below what you expected. Again, you put in a stop at 95, you end up filling at 88, which is again the risk of putting in a stop market order. We know you are going to get a fill, but technically we don't know what your fill price is going to be. Depending on where the stock moves next, you're either going to be very happy or very angry with this fill at $88. Now, the next order type we're going to discuss is a slight variation to this, and it's called a stop limit order. Stop limit orders are nearly identical to stop market orders. However, a stop limit order utilizes a limit order rather than a market order once the stop is triggered. This is going to mean using 2 completely different prices, the stop price and the limit price. Just like in the previous example, you will set a trigger at which you want to close out of your position. That doesn't change. However, with a stop limit order, you will also set a lower end threshold at which you're comfortable filling. Now, because this is a limit order that's being sent out, and limit orders are only filled at the order price, or better if a price is available, they are not guaranteed to be filled. If the stock were to gap below your limit price before filling, you will continue to hold these shares until the price moves back up above the limit. Using the same example as before, you have shares of XYZ company at $100 a share, and you want to close out of the position if it ever falls down to $95 a share. However, you're not comfortable selling your shares at any price below 93. This means you have a stop activation price of 95, which will then trigger and send out a limit order at $93 a share. In the event the stock were to fall down to 95, a limit order is going to be sent and only fill if it can sell for 93 or better. Now, let's say a large sell order was to enter the market, absorbing all the buy orders down to $94 a share. Your stop is going to be activated due to the stock trading below your activation price of $95 a share, which is then going to trigger a limit order to be sent out to sell your shares at $93 or better. In this example, the best buy order or bid available at the time is 94. Since this is greater than your limit price of 93, you will end up selling your shares at 94. Now, although you might find yourself being drawn to this idea of increased protection with this order type, keep in mind that you are not guaranteed to be filled when utilizing a stop limit order. If the stock were to sell off below your limit price before you get filled, you will continue to hold these shares until the stock rises back up to your limit price. So if you're utilizing a stop limit, you need to be comfortable with the fact that you may never end up selling your position and feel confident with the long-term outlook of the stock. The next order type we're going to discuss is a trailing stop. Now, trailing stops are not that much different than the previous two examples. A trailing stop order is an order that is entered with a stop parameter that creates a moving or trailing activation price. As the stock price moves, the activation price for your order will move too, allowing potentially profitable trades to run and may help protect against a sharp pullback. Now, the stop parameter can be entered in as either a dollar value or a percentage below the current trading price. For example, let's say you currently hold shares of ABC Company at $50 a share. You'd like to hold on to the stock as long as possible, but you want to close out of the position if it ever drops by $5 a share. This would be a trailing stop with a negative $5 offset. When you originally put in the order, your stop activation price will be $45. However, as the stock price rises, so too does the stop. Let's say the following day the stock moves to $60 a share. Your stop would also move up to $55 a share, always trailing the stock by $5. Once the stock price begins to fall from that high of $60 a share, your stop would remain static at $55. Once the stock trades at or below $55 a share, a market order is going to be triggered and sell your stock immediately at the next best price available. So like we talked about, trailing stops just move up along with the stock, whereas the previous two examples, stops and stops limits, those are static targets. The next one up is a trailing stop limit order. This is almost identical to a trailing stop, but instead of triggering a market order to go out there when the stock falls to an activation price, a limit order is instead going to go out. If you think back to our stop loss versus stop limit example, it's the exact same principle. With the trailing stop limit, you are setting a lower end threshold at which you'd be willing to sell the stock. The important point to keep in mind is that your limit price does not move up like the stop does. Setting a limit may be useful in the beginning of the trade, however, as the stock moves up and your stop up along with it, your limit order remains at the original price set. So eventually, this limit price is going to be virtually meaningless, acting basically the same as a trailing stop order. So again, basically exactly the same as just a regular trailing stop, except instead of triggering a market order, it'll instead trigger a limit order. Now, getting to the crux of probably why you searched this video in the first place, which stop order is best? Now, I really can't tell you for certain which one's going to be best in your situation, because obviously we can't foretell the future. If we knew it was going to happen next, then obviously we'd know which stop to use. However, in general, a stop market or trailing stop is probably going to be your best option. Remember, the entire point of a stop loss order is to exit the trade, and a stop market order is the only type of order that is going to always accomplish this. The additional losses that could be incurred from slippage are pretty minimal compared to the potential loss that could arise from a trade that's not exit at all. Remember, there is no guarantee that a stop limit or a trailing stop limit order is going to fill if the stock gaps below our limit price that we set. In addition, slippage can typically be avoided by trading high volume assets and not holding positions during major news events like earnings announcements. And while we can usually minimize slippage, the problem of a stop limit order not filling could be a much more serious situation, especially if you're not at your computer to get out of the trade if the loss keeps mounting and you want to get out of it. Now, I will say stop limit orders can be helpful, however, if you have the patience and confidence that a stock price will rebound. When prices are moving quickly, some traders would rather wait it out than accept a sudden large drop in price, and if you're willing to accept the risk, this could be an effective strategy for you. Now, I hope this video helped some of you guys out there. If it did, please hit that like button down below. If you guys do have any additional questions, please leave them down below in the comments and I'll answer them all as best I can. Now let's all make some money this week and I'll catch you guys all in the next video.